Hey guys, All in Crypto here, and welcome back, ladies and gentlemen, for another YouTube video. Hopefully you're all having a wonderful Thursday. Today we're going to be doing something a little bit different, and I really want this to be an educational video. And we're going to be focusing on some thoughts, some comments from Jamie Dimond. For those of you who don't know who Jamie Dimond is, he is the CEO or the head honcho of JPMorgan, one of the largest investment banks in the world. And he's essentially saying, brace yourself, there's turmoil and trouble ahead for markets, and JP Morgan are going to position themselves accordingly and try and take risk off the table to mitigate the damage that may be in front of us. Now, to reiterate this, we're going to start the video off with a clip from Jamie Dimond saying this. We're going to talk about it, and then we're going to look at the Fed funds rate. We're going to look at the bond yield curve. I'll also explain what all of these things are for those of you who are unfamiliar. And then, of course, being a cryptocurrency market channel, we're going to relate this to Bitcoin. And I'm going to be putting my fortune teller hat on. I'm going to be getting my crystal ball out. And I'm going to be trying to show you what I think the future of Bitcoin looks like. You guys know that watch me daily. I think the cryptocurrency market is going to see more downside. And this is going to relate to everything that we're going to talk about in this video. So stay tuned, guys. I'm going to be showing you a schematic of when we were in a similar period in terms of an economic downturn and kind of a crash. I don't really want to call it a crash, but similar kind of monetary settings to what we're currently on. We know what the policy is at the moment. From March 2020 onwards, Fed and other governments around the world essentially just threw money into the economy to try and keep it afloat. We're now at the other end of that, and we've got to deal with the consequences that come with it. And this is really a video that I want you guys to pay attention to. Many of you that are new to markets, new to investing, I think are going to gain a lot from this video. You guys know that we are starting up a paid Patreon membership group. We're going to limit the amount of people that are actually going to join because I want it to be very personal. Weekly meetings with me, my daily thoughts on the markets. And this is really going to be a taste of one of many, many topics that we're going to be talking about and trying to educate people on. Again, I'm not the best macroeconomist in the world. I know many people that are far more and talk with many people that are far more clued up than I am. But hopefully this is going to give you guys a good understanding of not just what Jamie Dimond is talking about and why he sees trouble ahead. And it has everything to do with the monetary policy. The Fed is literally the driver of markets in most cases. And when policy is loose and not aggressive, markets tend to do well. When interest rates are low, markets do well because money's a lot less expensive to borrow. And when interest rates are higher, typically markets don't do as well. And you can really illustrate this. If you look at the Fed funds rate, whenever you start to see an increase in it, typically a recession or a period of market turmoil, a downturn, ensues. You can see that, they started up in the Fed funds rate, the interest rate set by the Federal Reserve Bank in 2004. Of course, this was kind of the precursor for 2007's housing crisis. They did a similar thing in 2017. You had huge issues with the repo market. Then subsequently, obviously, the whole March 2020-19 thing happened. And you can see also in the dot-com boom, they were also upping interest rates prior, and then they have to reduce them. So we're bullish long-term on the cryptocurrency market because they are going to have to undo these interest rate policies. But the reason that they're doing them and upping them at the moment is to crush consumer demand. That's what their objective is, to fight inflation. It's one of the only tools they have in their arsenal. And this, of course, I agree with Jamie Dimond on a lot of things. Or not that many things, but this I agree with him on. The fact that markets are likely to see turmoil. So we're going to kick things off with a clip of Jamie, and then we're going to dive into it, and I'm going to give you my thoughts. Talk about the Fed funds rate, why that's going up and going to be detrimental for markets. Also the bond yield curve. We will change it from candlesticks to simplify this a little bit more. And then we're going to look at Bitcoin, where it is today and where I believe it's going. So strap yourselves in, guys. Again, this is a taster of what's to come in my paid membership group. It's not going to be a lot of money, guys, but we really want it to be a personal thing. And I believe that there's huge opportunities ahead that have the potential to literally change people's lives. One thing that I am a big advocate of is that investing can really move you in the right direction financially. So enough of me rambling on, guys. Let's play the clip and then let's talk about it all.
It's a hurricane. Right now it's kind of sunny. Things are doing fine. Everyone thinks the Fed can handle this. That hurricane is right out there down the road coming our way. We just don't know if it's a minor one or Superstorm Sandy or Sandy or Andrew or something like that. And it's you better brace yourself.
We'll leave it there. It was just a short and sweet clip. Short and sweet clip. But essentially what he's talking about is the fact that the Fed are not going to be able to deliver a soft landing, and they know that themselves. Them upping interest rates has already seen the likes of the equity market. This is Apple, for example, which we're going to be talking about in just a second. But we've already seen equity markets, that's total 2, not the one I wanted, slide on the back end of this. And I think this continues. And I think the rally that we're seeing for equities, that we've seen for crypto, is a relief rally, and you have more danger ahead. And ultimately people go, oh, well, they've priced it in. They've priced in interest rate hikes and what the Fed's going to do. I would argue that they haven't, because this is a ever-evolving situation that we need to all pay attention to as investors, as traders. My trading thesis, I trade every single day, guys. Sometimes I have a good day, sometimes I have a bad day. I'm not the perfect trader, but I make more money than I lose. And that's the key. My trading thesis for me on a day-to-day basis all centers around my macro view. You need to understand macro as an investor, otherwise you're going to be a lost sheep out there, guys. So brace yourself. Jamie Dimond warns of a coming economic hurricane that will require preparations as the Fed shrinks its balance sheet. So the Fed haven't even started shrinking. This month is the month they are going to start shrinking their balance sheet. That means they are going to sell onto the market, and they're upping interest rates again by another 50 basis points, and they're going to continue to do that until inflation subsides. We watch the commodity market like a hawk, pardon the pun there, because if commodities continue to go higher, inflation goes with it. Inflation is driven by mainly commodities. There's also a number of things like housing and stuff in there. But if inflation persists, the Fed are not going to pivot. So we don't get bullish on markets until the Federal Reserve pivot on the stance that they're on. And you can see here, I said there's a storm clouds, but I'm going to change it to a hurricane, he said, adding that the potential of an imminent economic recession requires preparation by banks. For JPMorgan, that preparation includes conservatively positioning the bank's balance sheet to be ready for an economic shock. You guys would have heard the term risk-off environment. Risk-off means you don't put money into risky assets because they're the ones that are going to get hit hardest with what is coming down the road. And this sounds very bearish and pessimistic. Guys, I don't think there is any bigger opportunity in terms of investment than the cryptocurrency market moving forwards. But we're in a sticky period right now, and we need to get away from that. Let's dive into the Fed funds rate, which is one of the factors at play here. Every time the Fed are the market manipulators. They are the guys pulling the strings, and when things are again loose, things are good. When things are tight, things aren't so great. And you can see, let's just look at what led to the dot-com boom and bust. Yeah, you can see the Fed starts up interest rate hikes. They go sideways for a bit, then they do one more push. This breaks markets, and then we get the 2000s crash. Can we see that in the on the Nasdaq? This is the 2000s crash right here. I'm not sure why I've got this up. Maybe I was highlighting this previously. And that, of course, so this is the dot-com boom. This is the 2007 crash. So this is the dot-com boom. This is 2017 crash. The Fed almost front-run that with interest rate hikes. Yeah? So dot-com boom here. 2007 crash, sorry. They started upping in 2016. Huge issues with the repo market. I'm not going to explain what the repo market is because it's not really that important for what we're talking about, although in terms of economics, it's very important. It's to do with banks and how they all essentially communicate and with one another. But they front ran March 2020 in terms of interest rate hikes. Huge problems in the repo market. Subsequently, after that, we saw March 2020 crash, which saw the Fed artificially prop up markets by flooding the system with money, which is why we have such high inflation now. I mean, they are the mass manipulators. What's happening today? Why are we seeing markets sliding off again? Well, that's because they're upping interest rates. It's key to market thesis is understanding interest rates and what the Fed is and isn't doing at any period of time, and how you can invest accordingly and come up with some sort of if you want to trade daily, base it, start right at the macro and go down to the micro. This is the yield curve. people don't understand what the yield curve is, but the yield curve is essentially when your bond yields, so governments issue bonds, money essentially is backed by debt, a promise to pay a debtor. When money comes into circulation, it's done via issuing debt. That's how we sort of gain money. But somebody has to pay that at some point. Now, people often buy bonds because of the yields that you get from them. When the yield curve inverts, it's essentially when your yields from a shorter term, so here we're looking at the 10s and 2s, so the 10-year yield off your treasury bonds is less, it should be more because obviously it's over a longer period of time, than the 2-year. And that's what, when you get when the 2 years higher in terms of yields than the 10-year, that's when you get this bond inversion. It's almost like, one way I look at bonds is like a voting mechanism for how well people think the economy is going to fare. And they don't have a great deal of trust in it at the moment, and certainly the US dollar, given the inflation that we're seeing. You know, they don't want to hold it, just like people don't want to hold cash. But right now, given how markets are looking, they don't really have an option. Cash is a position just as much as anything else. That's how you want to look at it. So we had the crash of 89, yield curve inversion happened, ran it essentially. Then we had the dot-com boom, which we could see the signs that something was coming down the road well before. We had the 2008 financial crisis. This yield curve actually took place in 2006. A crash later ensued. Then we have the precursor for March 2020, which is of course the 19 issue. When they essentially told everybody to stop working and everyone was on lockdown. And now we've just had the whole Russia situation. And this to me looks like it's going to roll over again. So this one took, I think, about 6 months for a crash to actually happen. This one, I believe, took nearly 2 years. Typically, there's been a 2-year kind of grace period before the crash actually happens. But the last one that we had didn't take as long at all. And this one, I don't think is going to take too long either. It could be anything. And this is what Jamie Dimond is talking about here. He's saying, brace yourself for what's coming. We are going to be conservative in regards to how we're going to allocate positions in this market moving forwards. You need to adopt the same stance as investors. We spoke, by the way, before we even had this second yield curve inversion about this. We also, on my membership group, actually looked at this before we'd even gone back inverted and said, guys, this spells trouble for markets, essentially. And when you look at the Fed fund rate, when you look at the fact that it goes up and typically markets decline shortly after it or in the making of it, this is where we are in terms of a market cycle. And they haven't even got as aggressive as they need to be. We haven't even seen interest rates get to where they need to be, where the Fed is saying they need to be. And where the Fed is going to put interest rates depends on inflation. My thoughts is they're going to definitely break something getting to the kind of levels. I mean, they're looking at 2.5%. You're going to break something getting to that. 100%. It's not 100%, but in my opinion, it's very likely. For example, I'm reading Paul Volcker's autobiography. Reason being is because Jerome has expressed time and time again his admiration for Paul Volcker, who was one of the most aggressive in a time in the 70s, late 70s. I think he was 74 to 79. They essentially had very high inflation, and Paul Volcker said, right, we're just going to up interest rates. Forget the markets. We're going to plummet this market. We're going to plummet the economy into a recession because we need to fight inflation at any cost. Fed's very much echoing that stance today. However, I don't think you're going to get anywhere near 20%, 17%, 15%. I don't even think we get anywhere near above 5%. I think, they're going to go until they break something and have to renege, but they have to give themselves the room. They have to go up in order to come down. How they often combat the recession is by bringing rates back down to zero. That's what they're going to have to do, guys. We could actually see negative rates when they actually bring them back down. So this is all really important stuff. This is affecting the crypto market from start to finish. Have I got draws on it? Yeah. So we'll just talk about it without drawing, and we'll actually take it off the candlestick just to make it a little bit more simplified. This, where I'm hovering my cursor, is March 2020. The Fed pumped markets full of money. Jerome Powell himself said we just flooded the system with money. He made no bone about it. And of course, crypto, the equity market, the housing market, the used sales cars market, everything saw huge appreciation off the back end of this. That has been pivoted 180. Not only is that stimulus not going into the economy, it's getting taken out of the economy in terms of reducing the balance sheets now this month and in terms of money becoming a lot more expensive to borrow. Not just does money become more expensive to borrow, but how many people out there have got mortgages that are not on a fixed rate? Those mortgages become harder to service, car payments become harder to service, corporate debt becomes harder to service. This all has an effect on the economy and ultimately leads to a slowdown. And again, this is what the Fed are trying. They are telling you, they are telegraphing you that this is what they want to do. They want to bring down markets. So what does that mean for crypto? Well, what we're going to do, guys, and this is how I envision, and I could be totally wrong, by the way, and what I'm trying to do, and I'm getting really fed up with the whole crypto YouTube and crypto Twitter space, because 97% of it is complete BS. People who have built up massive accounts off hot air. They haven't got a clue. They're just regurgitating nonsense that they typically get from one another. But you guys decide for yourself if my cautionary approach for the last nearly 5 months now has been warranted. And whether you think it's warranted moving forwards. What I want to do is I want to pull up Apple. Now, Apple is a tech company or a software company. And this is March 2020, 2008 or 2007, going into obviously the recessionary period, 2007, 2008. This is what I think, and what I'm going to do actually, guys, is bring these charts up next to one another. Let's not get Maker. The reason we got that up is because we're currently trading it. This is what I think your markets are going to look like moving forward. Let's get rid of whatever draws we've got on there. This is what I'm looking at. This kind of a period. Yeah, so we've taken out the one low. We're going to take out, just like here, have a little rest, see a little bit up, which is what we're currently going through. We've been looking for relief for a while now. We've even drew it down here before we'd even started to have that relief. I'm not sure what chart I'm using here. But then things continue to the downtrend and we see that bottom. This is what we're looking for. A structure like this, like what we saw at the bottom in 2019, that gives us the signal, coupled with economic and monetary policy changes, that's going to give us the confidence that I need to start investing serious capital back into this market and taking a punt on it again, going to the upside. Not interested in calling bottoms right now whilst we're in the kind of regime that we're in. And to pull Amazon up on its own, bring it back to the one chart, you know, we're so good at leaving the draw tool on. This is what we think the future looks like. This is the journey Bitcoin's going on. Yeah, remember, this is where the actual crash happened. But if Bitcoin really is what I believe it is, and crypto really is what I believe it is, a technological revolution that's going to change the world and integrate itself into our lives. Back then, nobody was really using Apple. Nowadays, everybody uses it in terms of iPhones and their computers and whatnot. Just like Amazon in the early days. We've made all these comparisons well before they were even talked about on Twitter. Go and watch my first videos ever on this YouTube channel. We were looking at Amazon, looking at Apple way before these Twitter accounts even existed. I don't mean to be bitter about it, but it is certainly annoying to see the kind of caliber of crypto Twitter space and crypto YouTube that's out there that actually does well, because it's not warranted in my opinion. But anyway, that's neither here nor there. So this is what we think the future looks like. Very comparable, in my humble opinion. What crypto is going through. Remember, in 2007 to 8, you had the kind of environment that we currently have. Yeah, in terms of it was a recessionary environment. We are not currently in a recession. The recession, and this is going to be funny, and some of you will get this. For me, the recession, and we can start calling this a recession when the ECB, the European Central Bank, up interest rates. That's when you know we're in a recession, and they've not done that yet. They're talking about September, but this is all coming, and this is all restrictive for markets. And is what you guys need to understand moving forwards. We want to help you in every way possible to be the best investors that you can possibly be, so that you can take that knowledge and change your lives in the same way that I've changed mine. Investing has changed my life 100%. And I think it can do the same for you. In fact, I know it can if you do it right. And that's why we're starting up this Patreon. And we're going to hopefully, get a really thriving community built on the back end of it. And this is just a taster for the paid group, this content's going to go into a lot more detail, but I'm just telling you guys what you need to pay attention to, why you have the likes of Jamie Dimond, who isn't always right. Remember, JPMorgan actually came out and said, look, Bitcoin's got a fair value of 38K, and everyone's like, oh, that means they're bullish. No, that just means they think it's got that could be the value of it. So they do put out a lot of contradictory things, but when he's saying a hurricane is coming, a hurricane is coming. We didn't need JPMorgan to tell us that, or Jamie Dimond, who has done very well in terms of being a hedge fund manager, and made very many right calls. Actually, I've followed his career, or certainly looked into it, and he's done well. He's the head of JPMorgan, the CEO of JPMorgan for a reason. He's telling you to be cautious, and he's telling you, look, we're going to position accordingly. And when you've seen this downturn that you've seen for Bitcoin, let's take a look at the FTSE's a weird one because the UK stocks are different. UK is not a very risk adverse like America. But if you look at this, the reason we've seen this downturn so far, this isn't retail going, right, we're out. This is institutions going, yeah, we're going to take risk off the table. That's still going to be the scenario. People giving surveys and what they actually do with their position allocation are two different things. People saying they're bearish and they see downturn doesn't mean that they've sold. That, I think, is still to come. And that's the message and the bias that I want to leave you guys with moving forwards. We're going to keep you up to date. Please watch my daily cryptocurrency market updates because we do incorporate some of this stuff in it. This was just a bit of an educational video that hopefully you guys find useful and entertaining, talking about the Fed funds rate, the effect that this often has, talking about the yield curve, talking about Bitcoin and where I see it at and where I see it going. Go and look at Apple during the kind of, it's not the same, but it's similar kind of pressures that we're currently under. And this is what the future holds, in my opinion, in the short term. But just like Apple, guys, things recover, markets bottom, and we see continuation. And that's the play for me until it isn't. Until we can pivot on our stance in an instant, guys, when we see that information present itself. It's not there yet, and that is the message that we are delivering today. So that is really all I've got for you in this video. If you have enjoyed this content, a like is always really appreciated. So is a comment. Do you want more videos like this when we go into this kind of economic cogs that are at play in regards to markets? Anyway, I'm rambling on now, guys. I'm going to love and leave you on that note. Enjoy your Thursdays, enjoy your weekends, enjoy the Jubilee. It's the Jubilee here, and I'll catch you all in the next YouTube video. Thanks a lot for watching, ladies and gents.